Hello, my name is Tejas Gajula, a junior at Michigan's Ross School of Business. As a proud owner of my Switch and PS4, I jumped at the chance to analyze gaming giants Nintendo and Sony. Today I'll be using Credit Suisse's HOLT Lens tool to evaluate and determine optimal investment opportunities. But first, a quick glance at the gaming sector, an ever-growing industry that experienced over $130 billion in revenue in 2018 with 10% growth. Consoles experienced the highest growth of 15%, with two highest-selling consoles being the Switch and Sony's PS4. Sony is a tech conglomerate whose division Sony Interactive Entertainment heads PlayStation development. Nintendo focuses solely on gaming, with consoles like the Wii, Wii U, and new Switch. Attached are the financials of each company and famous IPs who I'm sure you'll recognize, both sporting healthy PE ratios, with Sony being undervalued by 8% and Nintendo over by 13%. Sony has many revenue streams, but we will focus on their gaming services to better compare with Nintendo. At first glance, Sony has a higher scorecard rating, which could be attributed to their successful 2018. Sony's relative wealth chart shows recent wealth creation since 2017 and a corresponding increase in asset growth, showing that Sony is managing assets and cash very well after experiencing negative wealth creation. Sony reduced assets considerably in that time to try and boost CFROI levels, and it wasn't until 2014, near the PS4's release, that they started experiencing new growth. Currently, they are experiencing a slow fade as the PS4 reaches the end of its life. Their sales have been inconsistent, showing clear boosts when products reach the market. The dips in sales growth in recent years is what caused CFROI to plateau. However, asset turns and margins have been very consistent, showing potential for long stability and slower fade. Nintendo, on the other hand, is much more volatile, seeing their CFROI dependent on their console success. Between 2010 and 2013, they mostly reduced assets to simulate CFROI growth following the Wii U's underwhelming results. This paved way for a new booming life cycle, spawned by the Switch's great success for the company, being the highest sold console in 2018. Nintendo's sales growth is dependent on the success of their consoles. With high sales growth comes more asset turns, reinvestment, and positive margins. It's clear Nintendo is higher right now due to the Switch's great success, and are looking to take advantage of this momentum. Some other key valuation metrics to look at are overall accounting score, economic profit projections, and momentum. Sony, despite beating earnings projections, are hurt by a low accounting score and economic profit projections that fade due to the PS4's subsequent fading. Meanwhile, Nintendo has a high quality accounting score and constant increasing economic profit, showing less risk and more confidence in the short term. To conclude, Sony is a better long-term play and Nintendo a better short-term play. This is due to Nintendo having higher volatility but more success with the Switch, and Sony having more stability in the long term.